Hello, hello. Welcome to another and the third day of our SBA Maine Export Week. We've made a whole week of celebrating this, getting you resources and getting you information. This is being hosted by the Maine Small Business Development Center and the Women's Business Center, which is located at CEI. And as I said, this is an all-week affair. We're doing this every day, same time, same link. We already went through the first day, Monday, where we talked about, why you would want to export, some of the pros and cons. We talked about, am I ready? We talked about some resources there. And we had a kickoff from the SBA, kind of just getting our engines revved up for the week. Then after that, yesterday, we had the Maine International Trade Center come on and share some of their tools and talk about the STEP program. And we had business that partook in the programs that the Maine International Trade Center had actually talked to us for quite a length. So that was really, really good. We have a recording that if you have missed any of these days. Today, Wednesday, I'm very excited. It's all about export finance. We have a great set of people here to talk to you. We're going to talk with SBA, ExIm Bank, Navitrade, and a couple of the local banks here, Bangor Savings and Gorham Savings. They're going to have some great information for you as well. Tomorrow, if you tune in, it is going to be all about the export business plan. As we said in day one, if you missed that, there are two big questions on starting exporting. One is getting your plan ready to understand if you're ready to export, and two is understanding where you might want to export. And we had some tools and databases that you could do with that. So day four really gets into that export plan and understanding how to put that together so it makes sense to you, so you know if you want to or not. And then the final day on Friday, we're going to have an export panel of other businesses that are maybe a little ahead of where you're at. They're already exporting. And so this is your chance to ask questions like, what would you avoid? What was it like? What programs did you use? What's your experience been as far as, has it been beneficial or not? And have you seen growth? So that's going to be one that you really want to tune into. If you know someone that could benefit from this webinar, we are still accepting the registrations. As I said, one ring to rule them all. When you register for one, you're registering for them all. So there's the same link every day. Kelsey does send a reminder email in the morning just to make sure, with the link as well. But if you lose that email for some reason, it is the same link. This is being recorded. So the whole series will be recorded and will be put onto YouTube eventually. So we do have the Maine Small Business Development Center has a YouTube channel that you can subscribe to, and then you get notified when any of our videos pop up. So it is being recorded, but you won't be able to ask questions unless you attend the live session. So that's why we want to get to the live sessions. If you do have a question, we please ask you just to put that into the chat. I'm going to write a message right now in chat so all of you can see that. With Zoom, depending on where your box is, it's usually at the bottom, but you probably see a blinking right now because a new message came in. That's where you're going to want to put your questions. Try to make the questions general if you can, so everyone online can benefit from them. If you have a very specific question for your particular business, that's fine. Just on my picture here, you should see my email, right? And you'll get my email in a follow-up email. We're going to send you a link to the slides after this. So feel free to email me if you have a very specific question. But otherwise, any general questions, feel free. We will have a question and answer period at the end that will address any questions that weren't answered already and get to those. Now, speaking of putting things together and thanking people, we could not do this without a whole bunch of people agreeing to come on and share their expertise. So we have a bunch of people to thank, everyone on this page, right? And more. So thank you everyone for coming on, being a part of this and sharing your time. With that, we're going to kick off Day number 3 of Export Week. And we're going to kick off with Richard Foy, the Regional Director at Export-Import Bank of the United States. So Richard, I want you to take it away.
Thank you very much, Peter. Some great programming that they've put together this week for the benefit of the exporting community. I'm happy to be part of it today. Do you have the slide up or?
Yep, putting it up.
There we go. We're getting there.
Yep.
What I'm going to do today is run through some of the programs that that ExIm has, the reason we exist, what we look to accomplish in the marketplace, and I'm going to have some of the colleagues do the same with their programs. And hopefully throughout it, you'll get a good understanding of the resources that are available to you, but mostly know that you're not alone out there, that you have a lot of resources available. Everybody wants to help you. There are programs designed specifically to help exporters. I can't emphasize that enough, that you're just not alone. So when you have a little trepidation over an issue, just call anyone on this panel or reach out to anyone you've heard from this week. Next slide. First, we'll go over who ExIm is. ExIm is a small independent agency. We were founded in 1934 as part of the New Deal. The focus of the agency was to grow jobs through export. As part of that mission, we have a U.S. content requirement for all of our programs. So we look for products to be manufactured here, 50% or greater on a cost basis, and services to be derived from U.S. personnel as well. We're headquartered in Washington, D.C. We operate out of 12 regional offices. My regional office is in New York, and my areas of responsibility are New York up to Maine. We don't compete with the private sector, so we are very much in a cooperative relationship with banks, and you'll hear from a few today, as well as the private insurance industry as well. So we look to fill gaps where maybe a bank can't stretch enough to make a loan without our support. We look to give that support. Where an insurance carrier perhaps can't provide limits or coverage in a particular area, we look to take on that risk. What we look as a win is not the typical profitability the way an underwriter would. Usually it's, okay, can I make money off of this transaction? Our focus is a little flipped. We look to make sure that you can make money on a transaction, that you're able to execute on the opportunities in front of you. That's our core mission. Obviously, we underwrite things well. We are responsible steward of taxpayers' money, but the goal is not profitability directly. It's indirectly through your activity. Next slide. We, pardon me. So there are a few areas in which we can help you. There are funds to fulfill orders. We have basically the first and the third here are talking about financing. That's where you would have a bank involved. If you need money to fulfill an order for export, you would probably use our working capital guarantee. That's when we work with a bank. We'll get into some details there. Work with a bank, and we kind of stand behind the bank in case something happens. We're there to catch a bank, make them whole. Everybody lives to fight another day. The foreign buyer financing, that's financing that foreign buyer. So if you have some capital equipment where they need a few years to pay for that, you don't necessarily want to hold that receivable for a few years. You want to be paid once it's exported. The bank in that case would finance the buyer directly. You would get paid once it's exported. And just like on a mortgage on a house or a car payment, the bank would receive payments from that foreign buyer. Right in the middle there, you extending credit to a foreign buyer, that can be inherently risky, right? So what we do there, help you, we guarantee, we provide insurance on those receivables to make sure that if you're not paid by that foreign buyer, that we pay you, again, so that you're in a strong financial position to continue doing your business. Next slide. We are small business focused. This is something that's often overlooked by folks. They always hear that, we're financing Boeing aircrafts and GE, whatever. And that's true. We finance these big deals, and we generally that's our foreign facing financing. They pay great fees to us, and that allows us to offer these excellent programs for small businesses. You'll see 88% of our transactions supported were for small businesses. A lot of them were under 500,000, and we have over 1.5 billion in total authorizations. In fact, we return money. We talk about profitability. We're a government agency, so we can't be profitable really, but we're in negative subsidy, meaning we return money to the Treasury each year, which is something that I'm proud of, and I'm happy that a government agency is doing it as a taxpayer as well. So next slide. So yeah, our financing often makes the difference. We talked about leveling the playing field here. So if you're competing against another foreign company, we don't want them to have an advantage over you because of lack of financing or fear in the marketplace, financially speaking. We want to put you on the same playing field because we feel that a U.S. product will sell better, all things being equal. So that's where we're trying to level things. We're trying to minimize the risk of non-payment from your foreign buyer with our credit insurance, and we supplement commercial financing. We don't make loans directly, and you'll hear that from the SBA as well. We like to empower the private banking network that we work with. They work with their clients directly, and we just provide the support to make those loans happen. No company or transaction is too small, it says over here, and that is true, with a caveat. Our our guarantee programs are for the benefit of the banks. They choose which guarantee program best fits their needs, right? So you may go in there with the idea of, hey, I heard Rich talking about an ExIm working capital guarantee, give it to me. And they say, you know what, we'll give you the loan, but SBA guarantee. That's fine. We work very closely with SBA. Again, our programs are very similar with certain differences, and that's fine. You'll still get the loan, and you're in good shape. Next slide. So why do only 1% of companies export? Fear of the unknown, that's a given, and I hope through this week you're seeing that really shouldn't be a factor because you have a lot of resources available to you. But the other one is risk. So we're going to talk about the risk on the next slide, because risk is very real, and we want to make sure that you're in a good position. Our products start from pre-export working capital, so pre-export financing, and all the way to post-export financing. That could be insurance that we discussed, guarantees, or direct loans, right? Next slide. I'll talk about a working capital guarantee, and I'm going to turn it over to a colleague, Brent, for the insurance aspect. I don't always focus enough on working capital guarantee because I think our insurance program is fantastic, but it is important for you to understand where you can get that money, and arguably it's the first step, right? You need money to buy or make the product that you're ultimately going to export. So we'll talk about that now. What is a working capital guarantee? I alluded to this before, but this is straight up a guarantee to a commercial lender that makes a loan to an exporter for purchase or manufacture of U.S. goods for export. So we have a couple of things in there. The use of funds, all right? Use of funds is important. It can't be used to develop a product that you will ultimately, I think, maybe export. No, it's got to be a product that's commercially ready to export, all right? And if you have to buy that product or you're manufacturing that product to fulfill an order, that's an acceptable use of funds, okay? We can often unlock cash flow that you kind of have available to fulfill sales orders abroad, and you can borrow more with the same collateral. And I have a slide in a few that will identify that in a pretty good way. Our working capital guarantee also can be used for standby letter of credit, for bid bonds, and other similar type of financial instruments. a standby letter of credit would be required maybe if you get some advance payment. Let's say you have $1 million order, you're getting advance payment of $300,000. Well, a typical bank would say, okay, well, we'll issue a standby letter of credit. You just need to park that 300,000 in the account. But that does nothing for you as far as receiving benefit from that $300,000 because you need to use that to start making the product that you will export, right? So that's 100% collateral requirement in that situation. With an ExIm guarantee, you would only need 25% collateral requirement. So whatever the math is on that, it's too early for me to think, but 25% of 300,000, that's what you need to have parked. The rest of it you could use for working capital. Next slide. So we provide a 90% guarantee, and that's principal and interest. 95% can be approved. I don't know really what, usually it's 90%, so I won't even go into that. We set these up as a transaction specific loan. If you have maybe a large capital equipment order that's outside of your normal business, it's just a larger order and it's only for that particular customer, we set it up as transaction specific. Once that's order is done, you don't really have a need for additional working capital. Or if you are maybe selling to distributors, you have regular business that's ramping up, we would set that up as a revolving line of credit. So you get paid, it pays off the line of credit, and you draw from it again. Okay, we don't have a minimum maximum amount. I discussed that already. And our loan can support advances made against what is typically kind of, voodoo areas like, inventory, WIP and foreign receivables. Usually banks like really push down on those. They don't like to advance a lot on export focused goods and receivables. Next slide. So this is an asset-based, fully collateralized loan. Owners that have 20% or more stake requires personal guarantee. There's 100% application fee for this. Lenders work out the interest rates directly with you, so that's something that is negotiated. We have a guarantee fee that ranges depending on the loan size, and we have delegated and non-delegated lenders. A delegated lender basically has the power of the pen. They understand our underwriting requirements. We've given them the ability to underwrite under our credit standards and sign off on the loan. So it can be a shorter time frame for you to get that facility put in place. Or we have a non-delegated lender where you would just need a secondary underwrite by us. Next slide. Next slide. And next slide. Okay, this is a great slide I like to share with people because it really identifies the power of working with a guarantee. And this could be SBA's guarantee program or ExIm's for the purpose of working capital. So here on the left side, we have the collateral. We have export inventory and we have export foreign receivables as well. Raw material, WIP, finished goods. We have this amount. Typical advance rate, raw materials 20%. They won't issue anything on or advance anything on work in progress. Finished goods 50%, right? So are you getting 300,000 out of your 340,000 out of your $1 million export inventory, and out of your receivable $1 million, you're getting $420,000. Next slide. With an ExIm bank guarantee, we move that export inventory advance up to 75% and 90% on the accounts receivable. So that's a big difference, right? Going from 750,000 to 1.6 million. That can be a very meaningful amount when you're trying to unlock the potential of your export sales. Next slide. So I discussed credit insurance, and we discussed quickly here your open accounts receivable, and you see that nothing is advanced without an ExIm guarantee. I'm going to have Brent go over what, well, how we look at receivable insurance. All right, how we make all of what I discussed is putting the bank in a good position so that if there's a default, and the likely reason for a default is because you haven't been paid from your foreign buyer, right? That's my opinion anyway. So he's going to talk to you about how to avoid that and some other powerful elements of credit insurance. So I'll turn it over to Brent now. And thank you for your time.
All right. Thank you, Rich. Thanks so much. And great to be here this morning. Again, my name is Brent Hoots. My company is Navitrade, and I have one job. Only one job. I only have one slide too. So if you think I could do this, I'm going to walk you through a quick story about a client of mine from many years ago. And it's a medium to medium small size company. And they had not done much with international, and they decided they were going to really focus on this and make it a part of who they were. Important to note here, great management team, seasoned pros. These people were great. And yet they started pursuing international and became frustrated and bumped into a number of issues. And everybody was unhappy and very frustrated. So let's walk through that story on their own, where they ended up. Then we're going to talk about how we put in place an ExIm Bank program and solved all of their problems. So it's actually pretty dramatic, and it's a great story. So I was invited by the company to stop by. Again, they were a bit frustrated and had some issues. And I stopped by the company, was ushered into this conference room, and there at the table, we had this absolutely perfect group of people for my purposes. The head of international, the credit manager, the CFO, and the CEO. So we sat down and they wanted to give me the lay of the land. And the head of international started and was talking about that. She said, you know, they brought me on board and we're looking at markets in Brazil. Brazil is a great market. We should do really well there. And she talked about their market penetration strategy, which was going to be really aligning themselves with the right partner in Brazil. And I'd say the vast majority of my clients do that. We have a great market. We align ourselves with a partner. So she was excited about it and said, it's a great distributor and they think they can ramp this business up to $100,000 a month. Okay, all right. So that's a home run for them, really good. She said they are asking for net 90-day open account terms. Okay, so that's something, right? Net 90, that's out there a bit. And another day when we have more time, we'll stop and talk about overseas distributors and why they ask for longer terms, right? Sometimes you think, gosh, we have a great product, we're offering a good price. Why don't they just pay for it and we'll ship it, right? There's more to that story. And I'll say three things. Overseas distributors tend to be thinly capitalized. They tend to exist in high interest rate markets and also markets that lack financial liquidity. All of these issues result in a distributor really needing and requesting longer terms. So this is going to be a part of the game with international if you're really pursuing that. $100,000 a month in net 90-day terms. What does that mean? Let's walk through that together. So on day one, if we were to ship 100,000, then 30 days later, the second shipment of 100,000, 30 days later, the third shipment of 100,000. So we're ramping this business up to $300,000 outstanding, right? And then 30 days later, we're finally at the 90-day mark, and they make a payment on the 100,000, and we ship. And then every 30 days, they pay, we ship, so forth and so on. But net 90 and 100,000 a month really means you're going to, on average, have, in theory, $300,000 of foreign receivables outstanding all the time. So that's something, right? What is that? It's a risk for sure. For the vast majority of my clients, that's a substantial risk. And it's also something else. It's a cash flow issue. And it's a big deal for a lot of my clients. So the head of international is going through this and talking about this. And then the credit manager jumped in to participate. And he said, look, this is great. This international sounds really good for the company. But my job as the credit manager is to help the company prudently and reasonably manage risk issues. And he said, we have two things here. We have the country of Brazil and doing business there. And he said, you know, we can get our arms around that. And Brazil looks like a okay country. We've got that. And then he said, we've got this buyer, a distributor in Brazil. And what is the creditworthiness of this buyer? And creditworthiness, remember, is your ability and willingness to pay. So that's what a credit manager is very concerned about. And he talked about that, well, you know, we actually ran a credit report on this distributor and we've done research. We like them. We think they look like a pretty good distributor. So this looks pretty good. But he said, we are about best practices. And as a company, we really want to stick to that, which we applaud, you know, for all of our clients to go with best practices. And he said, look, for us, we should be extending net 30 and $100,000 credit limit to this buyer, not net 90 and 300,000. Okay, so we're bumping heads here with the credit manager and what we want to do with this distributor. But then the CFO jumped into the conversation, and again, another seasoned pro. She said, "Look, I'm also excited about the international, but even if it's only 100,000, much less 300,000." We start to bump into cash flow issues. So if you see we're going to start pursuing a lot of markets and overseas buyers and having open account terms, we're going to have an ever-growing mountain of foreign receivables if we get traction, right? So we're pursuing international. Why? We're pursuing this because we hope we get traction and we become good at this and start growing our international business. I have a client that I've had for 15 years. When we started off, at first they had 4 overseas buyers. 15 years later, with the help of an ExIm Bank program, we now have 120 buyers. Their international business has just exploded. They've done really, really well with that. So the CFO said, look, it's a cash flow issue. And I've talked to my bank, and our bank is not interested at all in financing foreign receivables. So, and is that true? The US banks not finance foreign receivables? It's true. They don't. They are not interested in foreign receivables unless they're backed by ExIm Bank or a comparable program. That's another discussion we'll have at another time, because it's a very interesting discussion about banks and their clients and everything. But she's right. At this point in the story, they're not familiar with ExIm Bank, and she's stuck. She has to manage cash flow issues. So here we have the head of international that's done great. We have a great distributor, a credit manager that's properly managing things, and a CFO with some real issues. The CEO then says, look, growth is everything. We grow or we die, right? So we need to do this business, and it's good business. Why don't we do this business and we'll pursue best practices? Let's go with net 30 and $100,000 credit limit. All right, so let's walk through that when we go that direction. And on day 1, we ship 100,000. 30 days later, the Brazilian distributor calls and says, okay, we're ready for the next shipment. Credit manager jumps on the line and says, no, wait a minute. Actually, we're really going to stick with net 30 and $100,000 credit limit. So we're at net 30. You owe us a payment. The Brazilian distributor says, we don't have the cash yet to do that. That's the end of that conversation, right? Another 30 days goes by. The distributor gets on the phone and says, we're really ready for product. We've developed the market. The channel's ready. We need product in the pipeline. The credit manager jumps onto the call at this point and says, look, we're very serious about net 30 and $100,000 credit limit. You're now 30 days past due. You really need to make payment. The distributor says, we're so sorry. We do not have cash from this product cycle yet. That's the end of that conversation, right? The next 30 days goes by as we're approaching 90 days. What's going on during that 30-day period? Well, the credit manager has his team emailing, calling, and pursuing payment from the Brazilian distributor. And the credit manager, his position is, wow, okay, they're way past due at this point. They are really hurting my receivable aging. They're not good, not a good buyer, not a good customer, right? What's the big deal though? Do we really care about a receivable aging? And yeah, you do. You care about it. Your bank cares about your receivable aging. Your investors do, your board does. When you have problems on an aging, it begs the question, who's minding the store? Who's managing these issues, right? So we have these problems now occurring as we're trying to stick to the best practices of net 30 and 100. We finally reached the 90th day, right? And they're way past due. At 90, the distributor makes the payment of 100,000, and then begrudgingly the company ships the next 100,000. But nobody's happy in this scenario. The distributor's not happy in Brazil because they're not getting product. The credit manager's not happy. This is a past due payment hurting my aging. The CFO's not happy. These transactions are not bankable. So it's a bit of a fiasco and everybody's frustrated. What is the head of international doing during this period? Well, instead of pursuing the next market, which by the way, who wants it? Who in the companies wants that next international market if this is what it's going to be like? No, that the head of international is pulled into this. When these things happen, a lot of people expect that person who developed that relationship to manage that overseas distributor. So we have a bit of a mess and nobody's happy about it. We suggested, and we put in place an ExIm Bank program. Not enough time to go into a lot of the details there, but the essence of the story is we presented this to ExIm Bank. ExIm Bank looked and said, Brazil's fine. They looked closely at the buyer and they said, this distributor is good. We're okay with 90-day terms and a $300,000 credit limit. Okay, so this is really great. And this is going to be very helpful. Everybody right now, stop though and give me a hard time about the story. You should say, well, wait a minute, Brent, earlier in the story, you told us that the credit manager was in fact applying best practices. And that really was strongly indicating net 30 and 100,000, right? So your question to me should be, doesn't ExIm Bank have to also play by those rules and go with the best practices for that industry with regard to credit and collections and terms and credit limits? The answer is no. ExIm Bank does not have to follow best practices for that industry. ExIm Bank has to follow best practices for who they are and their industry. So ExIm Bank is a global player, an amazing underwriter. This terrific team of people, 24/7, 365 in Washington, this is what they do. ExIm Bank is super networked globally with other banks, lawyers, other governmental organizations all over the world. They are a world-class underwriter. So ExIm Bank has to play by those rules, okay? And they're also backed by the full faith and credit of the US government. So the risk appetite is way beyond anything my clients could ever be interested in. So when you think about it, we want my client to stay where they should be at, and that is apply best practices and stay at net 30 to 100,000, even though they want to get up to net 90 and 300,000. So the value and the point of ExIm Bank is that we're going to get you to where you want to be, but where you shouldn't be on your own. So I'll say that again. ExIm Bank as your partner helps you get to where you want to be, but you shouldn't be there on your own. So, and that's huge. So we get ExIm Bank support. Now let's walk through it together real quick. On day one, we ship 100,000. 30 days later, second shipment of 100,000. The next 30 days, the next shipment of 100,000. So we ramp this up to 300,000. So the Brazilian distributor is thrilled. This is great. He's getting product. The credit manager says, wait a minute, 300,000. Wait a minute. Then he realizes, well, ExIm Bank is my partner, and ExIm Bank is protecting me at 95%. So I do not have a $300,000 risk. My risk is $15,000. So 95% coverage on that pile of transactions leaves them with only $15,000 of risk. Remember, on their own, the credit manager was holding $100,000 of risk, okay? But with ExIm Bank support, he's only holding $15,000. Also, on their own, they don't do 100,000 a month. They're going to do 100,000 every three or 4 months. Instead of $1.2 million for the year, which is the potential for this business, they're going to be constrained to 400,000. So on their own, they will only do a trickle of the business they could be doing with ExIm Bank supporting them. Now the credit manager says, we're good. It's only $15,000 of risk. I'm good. The CFO says, wait, $300,000 outstanding? Oh, that's a cash flow issue. Then she stops and realizes, no, ExIm Bank is my partner. I've talked to our bank about this. We can include those foreign receivables in our borrowing base. So the CFO says, we're good. Matter of fact, we're really good on this. If you want to do this again and again and again, in as many markets as you want, it's scalable. The CFO's position, we're bringing financing along with this growth. We can do this all day long. On their own, you run out of cash. If you can't finance these foreign receivables, you hit a wall at some point. So we now have moved a scenario of everybody unhappy to now everybody's happy and the CEO's thrilled. That's the story. And these are issues that day in and day out, these exact issues, Rich Floyd talks to companies all day long about, and we see this over and over and over again. So that was my story. I hope that was fun for you all. And I would like to make one comment about Rich. He's an extraordinary resource for the state of Maine. Everybody needs to get his cell phone number and be talking to Rich, on a regular basis. He's a phenomenal resource for us. And that's it. So thank you for having me join in. I'll give it back to you, Rich.
Excellent. Thanks so much, Brent. That's a great story that I think illustrates, the power of export credit insurance, and arguably having, a great broker on your side to kind of, walk you through this and figuring out the best path forward. I'm just, Brent really killed it on explaining, what the credit insurance is. So I'm just going to, and the value of it. Kelsey, if you could just skip to the what is covered slide. I think it's like 4 or 5 up. Yeah, there you go. I just want to highlight, what's covered, because we talk about credit insurance being there in case your buyer doesn't pay. And we're talking about, so on the commercial side of things, insolvency, bankruptcy, protracted default, which basically means if they're not paying in accordance to the contract, slow pay or things of that nature, and political risks, which are very important, especially I'll say now, war, revolution, insurrection. Currency transfer risk is very important now. Countries are having great, deal of difficulty getting U.S. dollars out of the country. So even if they really have the ability to pay because they have money in their accounts, you don't have the ability to turn it into U.S. dollars in which to pay you. And cancellation of import and export license is another one that shouldn't be discounted. It's very important. These things do happen where you'll have some goods on the water and then they just won't be allowed into the country. So these are things that are government, I'll say, induced, and and our credit insurance policy will cover them. And I think fast forward 2 more slides to the policy types. I'll just briefly go over this. We have a few different structures. Multi-buyer policy is a great structure where if you, we have different buyers. We have a policy in place for the exporter, and then we give credit limits for each of the buyers under that buyer, that policy, excuse me, with their individual limits and tenor and so on. So it's all wrapped up. We have the pricing on that is a global pricing, because we have spread of risk and the ideas that you're shipping to this part of the world, that part of the world, that we just give you a blended rate. If you have the need to gap fill, if you have a private carrier policy, you need to fill a specific need, or single buyer policy might be best for you there. Like the case of Brazil, maybe that one buyer was all they really had the need to cover at that given time. We see this all the time. So we put a policy in place, an annual policy for that specific buyer. Then another buyer comes in, you can add another policy to that until such time as you say, you know what, just cover my whole portfolio.
Yeah.
So
Rich,
yeah.
Just a quick comment on price. In the story we just went through, that company would be $400,000 a year on their own. With ExIm Bank support, they're going to do $1.2 million. I have no clients that take issue with price. Okay, so just to mention that pricing for with ExIm Bank is phenomenal. And what price would you not pay to achieve that? Sorry, go ahead.
Yeah, I fully agree. I mean, when you think about the security as well as the potential to unlock additional working capital and all of the benefits of credit insurance, cost does become secondary. So I included some other slides related to this program, because we're going to be distributing this slide deck. But I think Brent did a great job. So I'm just going to fast forward, and Kelsey will turn this over. I think Joe will explain the various benefits of the SBA programs at this time.
Excellent. Thanks, Rich. Appreciate it. And one thing I'll mention on the credit insurance, and maybe it was already covered in yesterday's webinar, but I do believe in Maine that the STEP grant program can be used to offset credit insurance policies. Is that accurate, Rich or Brent?
In theory, but STEP grants are managed, for example, in the state of Maine, that's really managed by the Maine International Trade Center. So you have different management of STEP programs around the country. And an issue there is how people want STEP funds allocated. In theory, that's correct.
Okay.
No, if people argue that's the best use of STEP grant funds, but it's possible.
Perfect.
Another reason to have a conversation with the Maine International Trade Center for sure. Yeah,
it is an eligible use. Good point. All right, well, good morning. I'll kick off the SBA side. And Brent, thanks for that. I love your story, and I think I've got a slide or two that kind of is directly connected to exactly what you were talking to. So again, my name is Joe Raycraft. I'm SBA's Export Finance Manager for the New England region, and I'm just one of 20 plus export finance managers around the country. So we're here to really promote the SBA's export loan programs. We work very closely with the SBA lenders and small business exporters. And today we're joined by a couple of local lenders. We have Julie Viola from Gorham Savings and Andrew Furman from Bangor Savings. Both have done some export loans with SBA guarantees, and they're going to talk a little bit later a couple of success stories that they have. So we're going to try to give you a lot of examples versus, you know, I don't want to bore you with all the details of the different financing and the criteria. I think just providing examples of how these programs are used, and kind of to Brett's point, like it's the point where the companies need to make a decision on their exports, and whether that's export financing, whether that's export credit insurance, or typically it's a combination of both. So we can move to the next slide. I'm just going to give you a brief background on SBA, then we're going to talk about SBA's general requirements, our role in commercial finance, and then we'll talk more about the export financing program specifically. So SBA was created in 1953. We're an independent federal agency, again, really to provide three things. I say the three C's: to provide counseling, capital, and assistance with government contracting. Again, specific focus towards small businesses. And when we talk about a small business, the way SBA defines a small business is really based on your industry code. And you can go to our website and check, but in general, most businesses with 500 or less employees are typically eligible for SBA. So if you fall into that bucket, you're most likely going to be eligible. Within the SBA, there's the Office of International Trade, and that's the group that I'm with, and we focus on, again, providing the counseling and the capital to small businesses that are doing business internationally. I think on Monday and Tuesday of Maine Export Week, you talked a lot about resource partners and all the different resources that are available through the SBDC, the U.S. Commercial Service, MITSI. I mean, there's just lots of resources available for small businesses, and SBA is just another one of those. Next slide, please. And just in terms of requirements, I'm just going to hit these quickly. To be eligible for SBA, I always put this one first. If you're one of the owners of the business and you're 20% or more, you're going to need to provide your personal guarantee. And that's not something you can negotiate with your lender. It's just a firm rule by the SBA. We need to have a reasonable assurance of repayment. Like most banks, SBA is a cash flow lender. We want to make sure that whatever loan you take, that your cash flow, historic cash flow, demonstrates that you can repay the debt. We ask that the loans be collateralized by at least a first position on any assets that are financed. And we recognize that a lot of the businesses we work with are what we call asset light. So if you're a service company or a distributor, you may not have machinery and equipment. You may not own your own building. So even if you take on a loan, the collateral is probably less than 1-to-1. And those are SBA is very comfortable with. And your lender is too, because with this SBA guarantee just gives them a little extra comfort. We like to see companies that have, some reasonable invested equity, skin in the game in the business. Companies must be located and primarily operate in the US, and all of our loan proceeds must be used for the benefit of the domestic operations. We can certainly support the export side of the business, but if you're a manufacturer and you have another location in Europe, let's say, and you want to buy a piece of equipment for a manufacturing facility in Europe, that would not be eligible because the asset is now outside the US. Businesses are eligible if they're at least 51% US owned, or the owners are legal permanent residents, and also no prior loss to the government or delinquent federal debts. That includes things like student loan debt as well. Next slide. Some of the challenges of getting a business loan. Well, this is what your lender is looking at, and I'm not going to spend a lot of time on this slide. It's the 5 C's of credit. We've all probably heard about it: character, capacity, capital, collateral, and conditions. These are really the 5 categories that lenders look at when they're reviewing a loan application. Again, we kind of hit on slides, so I don't want to be repetitive. It's just something, think about these, each of these areas and how your company can answer those questions. And that kind of goes into that, I think, the business plan that you have when you're going to a bank. You want to make sure that you're covering these in that business plan. And if you need assistance with that, I think you know where to turn at this point, and that's probably Peter in the SBDC. Next slide, please. Again, SBA's role in commercial financing. We're not a direct lender. We work directly with our partner SBA banks, where we provide guarantees to the banks, which incentivize them to make loans to small businesses that may not meet the bank's credit policies. So these are just some examples of where an SBA guarantee is important. Collateral shortfalls, we talked about that. Companies that just don't have a lot of hard assets. We're looking at the cash flow. If you demonstrate cash flow that can repay the loan, then that's certainly a good sign for the underwriters. Things would be acquisitions and change of ownership deals. Those are typically riskier transactions. A lot of times lenders will look for an SBA guarantee to support a business acquisition. Startups or relatively new businesses or franchise. Again, if there's longer maturity is necessary, if you're buying a piece of equipment or real estate and the lender is not able to provide a longer term, they can rely on an SBA guarantee that can help do that. And then just things that are outside the lender's credit policy. Maybe it's an industry that they're not familiar with or not comfortable with, or there's some management experience is not very deep. Those are reasons why an SBA guarantee may be important to a lender. All right, next slide. Now we'll talk about the Office of International Trade and what we do. We've got 3 things here. 1, export advice and counsel grants to find international buyers and financing for international sales. I think numbers 1 and 2 have been covered already in this webinar series. So today we're really going to talk about number 3 and the export financing. For the Office of International Trade, our mission is really to increase the number of small business exporters and also the volume of small business exports. And I think Rich had the slide indicating, I think 1% of companies are export. So we need to increase that number, but also increase the volume that existing companies are doing on the export side. And you can see we've got website links within the presentation, so you can click on the link for the STEP grant, to learn more about that, and also guidance on our export financing. Next slide. So this is the busy slide that's going to be most of the nuts and bolts that I'm going to talk about today. After this, we're really going to get into specific examples, which I think kind of what Brett laid out. I think examples, at least for me, I tend to pick things up and it sticks with me. But just briefly on these three programs that we have an Export Express program, Export Working Capital, and an International Trade Loan. The differences are, the first two, Export Express and Export Working Capital, these are primarily used for working capital needs. Export Express is maximum loan size of up to $500,000. So typically it's for a smaller company with less working capital needs. They do very similar things. So just because you're a smaller business, you're going to be able to benefit from the same advantages that our Export Working Capital program has, which is up to a $5 million maximum loan size. Things like standby letters of credit, Rich mentioned. Our lines of credit can be utilized to issue standby letters of credit with the same reduced collateral requirements that Rich had talked about. And I got a brief slide, we'll talk about that. And then the last program, International Trade Loan, is really just a standard term loan. So that's for a company that has growing exports and they're looking to acquire maybe a piece of machinery, they need to expand their capacity, maybe even real estate, some permanent working capital, or refinance existing debt. Again, pure term financing. This is something that we can provide a company through its lender. All of our programs come with up to a 90% guarantee. So it's slightly higher than the standard 7A SBA lending programs. And the reason being is the SBA wants to be supportive of the banks to approve these types of transactions and to work with exporters. Next slide. We do look to see an export business plan when a company is applying for export financing. And this is directly from SBA's standard operating procedures with kind of the minimum requirements for an export business. See, to me, I say it's a pretty low bar. Peter's probably scratching his head saying, you really call that a business plan? But again, it's the minimum requirements. It gives you something to put in front of your lender when you're applying for an export loan. And again, you're demonstrating, well, this is what my revenue projection is for the next 12 months. Here's a brief, summary of the business, what we do, the products we sell, how we export, what countries we export to, how we get paid, and then an explanation about how the loan will help the business either enter new markets or expand in existing markets. So it's typically a few page document. It's not a 50-page document. So I certainly encourage you to work with an SBDC advisor when you're looking to go for financing to support your exports, because it will really help with that conversation with your lender as you apply for a loan. Next slide. Of course, I have to cover interest rates. I'm not going to spend a lot of time on this, but you can see all of our different SBA programs, SBA Express, 7A, Capline, etc. Most of those have a maximum interest rate. So SBA doesn't say it has to be this rate. We just provide a maximum interest rate that lenders can't exceed. And again, these are all negotiable. Our Export Working Capital program is totally, there's no restrictions by the SBA, and that's totally negotiable between the borrower and its lender. Next slide, please. This is, again, we're going to get into some financing situations and examples. Rich pretty much covered this type of example, which is the need for a standby letter of credit. Again, a company receives a big order, $1 million order from its customer overseas. They negotiate a $300,000. That's great. But then the customer says, well, in return for that $300,000, we'd like to get an advance payment guarantee, which means if the company's not able to execute under the contract, the Indian buyer can get their $300,000 advance payment back. So the way that we structure this would be through a standby letter of credit that serves as an advance payment guarantee. So Rich gave a similar example. We get $300,000 in, but with an SBA or an ExIm Bank guarantee, we can issue that $300,000 standby letter of credit with only a 25% cash collateral. So in this case, we would put $75,000 into a secure control account that the loan control, and then the remaining $225,000 would be available for working capital. Again, just one of the specific, situations and, advantages of having an ExIm Bank or an SBA guarantee. Next slide. So I'm going to have Andrew Furman from Bangor Savings. This is a recent transaction that the bank did for a company in Maine. It's a seafood wholesaler. And Andrew, if you want to come on the line and again, give a brief introduction of yourself, of the bank, Bangor Savings, a little bit about what you do, and walk us through your loan discussion.
Thanks, Joe. Good morning, everyone, and thank you for being here and on this call. So my name is Andrew Furman. I am the Government Guaranteed Loan Program Manager here at Bangor Savings Bank. I lead a small team of subject matter experts within our commercial banking division, and our mission is to help our commercial and small business lenders and their teams, and therefore through them our customers, navigate the complexities of government guarantee loan programs. For example, SBA's export loan and export express programs. I've been with the bank for about 10 months now. I'm relatively new here, and I came to Bangor Savings from a local credit union where I'd worked for 12 years prior. And I'd be remiss, of course, to mention that in addition to your typical commercial and small business loans, lines of credit, and account services, Bangor Savings Bank does also offer services as well for small business owners personally, as well as payroll services and wealth management services. So the case study that I want to discuss today is of a frozen seafood wholesaler. Now, this particular business relies 100% on exports for their revenues. They are entirely an export business. They previously were a customer of the bank for several years at least, and leading up to late 2021, when they came to us looking for a line of credit to help finance that funding gap between the receipt of their payments from their buyers and when they have to pay their suppliers, which is just as Brent was referring to earlier with those 90-day net terms. And again, this was an existing customer of the bank. We had a great relationship. They were financially strong and certainly demonstrated the ability to repay a line of credit of the size they were requesting and to manage it properly. But there were still some credit concerns that made the bank hesitant to say yes. The first being the limited collateral, which Rich was kind of speaking to this earlier. The collateral to secure the line of credit is largely those receivables with overseas buyers. And in this particular case, it was the receivables that were concentrated amongst a relatively small number of foreign buyers. And so, there's an added level of risk there and discomfort, if you will, from an underwriting standpoint. In addition to that, just based due to the business model and the industry in which they operated, their profit margins were typically relatively thin, and they were reliant heavily on sales volume heavy sales volume to make make the cash flow. In addition to that, of course, we're talking about commodity prices, which can fluctuate, especially when we're working with buyers in various other foreign countries. So that also helped cause it to be a bit difficult to forecast the coming years' revenues and therefore cash flow and working capital needs. And lastly, just the bank's comfort level with financing foreign trade in general. Honestly, it isn't something that the bank had all that much experience in. But with everything that we've discussed so far this morning, thanks to the partnership that we have with the SBA and our other resource partners in utilizing the Export Express program, we were able to say yes. We were able to process this and make this line of credit for this customer to help them grow their business. And it proved to be rather timely, as 2022 turned out to be a bit of a softer year revenues wise for them. Their sales actually went down somewhat significantly at 26% compared to the prior year. Due again largely to the weaker economies in their target markets of foreign countries, which, as you can all imagine, it's difficult enough for us to forecast and predict what's going to happen in our own economy, much less those of other countries overseas. And so, thankfully, this line of credit was there to help provide them some flexibility and confidence to navigate this softer sales year. And it turned out to be a great year despite that. Not also due in part to they did a great job of controlling expenses and costs as well. But it allowed them still in this down year to pursue new markets and attend overseas trade shows and try to grow their business. And thankfully, as it said, the business had been with us for 7+ years. We had a great relationship with them, and they're a great borrower. We wanted to say yes, and thank you, and thanks to the SBA and our partnership with them, we were able to say yes, which is always more fun than the alternative. So we were grateful for that.
Andrew, I got a quick question for you, and I'm just curious, you kind of answered it, but that 7-year relationship that you had with the company, how important was that to you when this loan request came through? Is that an important consideration for the bank? And I just think it's important for the audience to hear how lenders think about those relationships they have when they get a loan application from a customer that may not have been a borrower in the past, and now they're looking for debt, and now they present you with a somewhat challenging case. So just walk us through how kind of you think through that.
It's certainly important. It's not necessarily it's not a requirement, of course, but it's certainly important, and it does help. If we have an established relationship where we already know them, the borrower, they already know us, there's just a added level of familiarity and trust in play that may not be there if it was a prospective new client. And again, that's not to say that that would necessarily be something that would cause the bank to say, sorry, no, not at this time, but it's most certainly a consideration and something worth considering for any small business owners on this call or out there that are considering getting into exporting, to leverage the banking relationships that you have in existence at that time, to try to get that done.
And did this, I don't recall, did this transaction, did the company have credit insurance on its overseas buyers?
That's a good question. I don't believe so.
Right. And SBA does not require it. We do certainly encourage it, but no, it's great. It's great to hear. It's a great story. And I know you know, seafood exports can be tough. I mean, it's a perishable item. Lenders don't always like that. So I'm happy that, you know, the SBA was able to support it with an export loan.
Well, thank you, Joe. Thank you for the opportunity to speak to it.
Oh, you're welcome. And I think we'll come back with some other Q&A later on. But let's move to the next slide. And I want to bring on Julie Viola from Gorman Savings. She has a loan discussion here for a manufacturing company in Maine that utilized an export loan. And Julie, again, if you wouldn't mind just taking a few minutes just to introduce yourself, talk a little bit about your Gorham Savings, and what you do at the bank, and you know the services that you provide to your customers.
Sure, absolutely. Thank you. It's great to be here this afternoon. My name is Julie Viola. I am a commercial lender here at Gorham Savings Bank. I am finishing my 22nd year, I think, here at the bank. I also manage the small business banking group. So as you can imagine, there's a lot of different things that I do in the course of my day. I'm a Portland native. Gorham Savings Bank is headquartered here in downtown Portland. We have locations throughout southern Maine. And Gorham is a mutual. So kind of like the credit union model, as a depositor, you're an owner of our institution. We underwrite our deals here. I have my own loan authority. You know, we underwrite them, decision them. You pay them here, and we kind of, you know, live and work in the communities that we serve. And just like Bangor, we do have a full suite of products, from, you know, deposit products to credit card processing to just about anything that a business would need to interact with their money to help them kind of navigate the process, whether they're doing domestic or exporting business. You know, and I think the interesting thing in terms of what my role is here at the bank as a commercial lender, I do, like I said, manage a small business banking group. So there's a team of lenders that, you know, we've worked throughout the greater Portland community for working with small business owners, but I also manage my own commercial portfolio. So I have customers of all sizes, you know, very, very small ones to very, very large ones, to startups, to, you know, all kinds of different financing options. You know, something that we've seen a lot of in the last couple of years is people who are purchasing businesses, and we're financing those purchase and sale transactions. And the SBA has been a tremendous partner to us here at Gorham in the last handful of years, from PPP lending to helping everybody navigate EIDL lending to this 7A program, as well as I do a lot of SBA 504 financing for equipment and real estate for your business. Being able to sort of understand that the 5 C's of credit, the cash flow, the collateral, the credit piece, is something that is very unique and sort of, you know, leads into our story. And this is a manufacturer. So if you think about a business that is manufacturing stuff, their balance sheet was leveraged. They have a lot of equipment needs that they need, and equipment is expensive. So there is borrowing that, you know, they have behind the scenes to finance that equipment. And, you know, while they were experienced in the plastic component industry throughout the United States, they were coming to the bank to seek a line of credit to support their existing receivables, but also to build inventory, because they were going to have an opportunity to expand the business sales, expand sort of their reach, but also begin exporting. And, you know, as Andrew, you know, mentioned, I mean, not that outside receivables are things the bank gets excited about, but this was a business that had always been a domestic company. All of their customers were throughout the United States, and for the most part throughout the Northeast. So, you know, they were maybe a car ride away from this company. But now being able to obtain the raw materials to put this product plastic component together and then get it shipped to Mexico and get it paid back, that was something that the bank was struggling with a little bit. Now, this wasn't a huge percentage of their total sales, but in terms of sort of the overall risk component or their capacity to be able to execute on this plan, it was a little bit untested. So, you know, as we did our traditional underwriting, you know, what is cash flow? What is the collateral for this line of credit? You know, how is this business's balance sheet kind of shake out compared to their peers, say in the manufacturing industry? And their request was really to be able to bring in raw materials for a product to go to Mexico that they really hadn't done before. So as you can see, there was just some trepidation in the underwriting process and what we were comfortable wrapping our arms around. So turning to the SBA to be able to provide that guarantee gives the bank sort of that extra check mark to say, from a historical perspective, your business has honored its obligations, made its payment. It looks like you can afford to make these payments on the line of credit. But now that you're going off and expanding into an area that is a little bit untested, we have the SBA behind us to say, we'll provide an agency guarantee just in case, things maybe don't go as well, or maybe, good case scenario, things take off and, Mexico becomes a big part of what they're doing. In today's discussion for this business, they're still exporting to Mexico. It wasn't as huge as they, as one might anticipate, but it has become a vital customer for them, being able to get raw materials. And if you think about, as you're producing a product, you're gathering those raw materials, and those vendors are expecting to be paid timely, not for it to go through your shop to be manufactured, sent off to Mexico, and then wait for that vendor to pay you back. So paying those vendors timely was really important to this customer in order to be able to maintain good vendor relationships and have credit terms with them. So the line of credit kind of gave them that breathing room for cash flow. It gave them the breathing room to expand their sales and try a new customer base. And, at the end of the day, they did expand to Mexico. Like I said, it wasn't a huge portion. It's a component, not a big area of expansion. But the SBA guarantee gave us that level of confidence to say, okay, this business that has a legacy business underneath it is now going to be expanding. And I wouldn't be surprised if they look to go to other countries or other areas. But just being able to test the waters on a small basis did give us just a little bit of uncomfort for a traditional sort of line of credit. So I think, the SBA works their magic in terms of being able to provide, our deputy district director calls it a little something, something. When you've got a deal, Andrew laughs because that's what she says all the time. We've got a deal, and the basic components are there. But those weaknesses are the place where, as banks, we want to make safe and sound loans. We want you as the customer to be able to repay the bank. But that agency guarantee sort of gives us that little extra checkbox to say, just in case the unexpected happens, there is sort of an ace in our back pocket to help, pull things together if things don't go as well as they could. So hopefully that was a good description of an existing business expanding on the export side that needed to have a line of credit to maintain their vendor relationships.
No, that's a great example, and it's a little bit different than Brent's example, where that company had an existing line and then they had the export receivables that weren't eligible, and there was a liquidity issue that kind of forced their hand to credit insurance, and then those were eligible for the line. In this case, it's almost like more like purchase order financing, where there's a specific order. So you as the bank say, okay, great, we'd love to increase your credit line, but the increase was purely really to support this project. And like, maybe they never did anything in Mexico before. So there's added risk there. So I'm just happy that, you look to SBA and specifically the export loans, because I think this is kind of a perfect, another example of how our programs can be used. The example that Andrew gave, I always say there's three reasons why a company is going to use an export loan. The first one is kind of like what Andrew presented. These are typically smaller companies that are like literally 100% export. So if they're going to get financing, it's export financing by nature. The second one is kind of what Brent laid out, was again what I said. They have an existing line of credit. Those export receivables aren't eligible, and now they need that additional liquidity. So they start to move towards a credit insurance and extending payment terms to the overseas buyer. The third one is really, I think, what Julie presented, and that's kind of that purchase order financing, where you may negotiate an upfront payment or not, but you pretty much are building whatever materials are necessary under the contract, and there's not a receivable really in place. You're not extending term. You're extending terms, but your payment is at the end. So purchase order financing is a little bit different. And again, a very, I think, powerful use of our programs. Let's go to the next slide. I have one more example I want to show. We did a success story, and it's a good continuation of what Julie had presented. And this is a manufacturer in Massachusetts, and you can, I think it's on our LinkedIn page, the Office of International Trade's LinkedIn page. The name of the company is Williamson Corporation in Massachusetts, and they're a manufacturer of temperature sensors, and they're significant exporters. They've got distributors all over around the world, and they did see a big increase in demand from their overseas customers. And this was during COVID, so they were up against a situation where they really needed inventory, and these temperature sensors that they made had a lot of those little electronic components that nobody could get. And their lead times went from 8 to 12 weeks to about 52 weeks very quickly. So at the same time, they were introducing a new product. So now they had even more of an inventory need because of that new product, but then they couldn't get the existing components for their existing product line. So they were forced to go and almost purchase a year or more's worth of inventory just so that they could keep the manufacturing line moving. So working through their lender, they negotiated a 10-year term loan, again, monthly principal and interest payments for permanent working capital, meaning it's a permanent increase in their working capital that's termed out over 10 years. And typically, lenders don't like to do this type of financing because it's a mismatch. It's financing short-term inventory with long-term financing. And that's like a no-no in the world of finance. However, like a lot of things that happened in the pandemic, things changed. And this was necessary for this company. The bank could only offer a 5-year term conventionally. They liked the business, they liked the company, they liked the cash flow, but they really felt that a 10-year term gave them a little bit of cushion because now the payments were a little bit less over a 10-year term versus 5 years. So they were able to make that loan, and company's doing great. And they also utilize, I believe they use the Massachusetts STEP program that allows them to participate in some trade shows overseas that they go to every year. So that was just, again, another example. We can go to the next slide, and maybe we can open it up to Q&A at this point. Rich talked about the export working capital programs. I have a slide here that puts the ExIm Bank and the SBA working capital program side by side. I highlighted a couple things on the SBA side. So under our export working capital program, our maximum loan size is up to $5 million. ExIm Bank has no maximum. So for companies that are really growing quickly and they have a need of close to 5 million or 3 million, we may just push them over to ExIm Bank because they're going to graduate too quickly from our program. The other uses of our program that ExIm Bank cannot support is if the US content is below 51%. We have no US requirements for SBA. So that's certainly an advantage of the program. We can also support military and defense exports, which for many cases, ExIm Bank is not able to support. So those are just some of the differences between the two programs. Again, as Rich said, any questions, reach out to one of us and we'll help make sure we get you to the appropriate the program that's going to work best for you. I do have additional slides here with some other financing situations. I think in the essence of time, it might be more productive to open it up to Q&A. So let's move to that.
Yeah, if anyone has any questions, feel free to put it in the chat or raise your hand at this point, I guess, because we could I see Tom Fox is literally raising his hand.
Yeah, I thought I put it on the thing, but hey, great presentation, guys. This is awesome. I think I have a little. I'll try to keep it brief, but I have a couple questions kind for each of you. We have a forestry company, and we're importing and exporting. Just exporting recently, United States. We have the largest bandsaw mill in the world, manufactured in Kentucky by the Amish. And this is going to Richard Foy, and it's a question on I have a company in Sweden and a company in Canada, and as we look at these exporting opportunities, I'm interested in. We're using ourselves as channel partners. So the question is, as we develop this pricing strategy, global pricing strategy, do you have any advice on establishing this transfer pricing, and then also what may be available for us to, is it possible to use these programs and have yourself or have interest in both sides? In this case, I would be the 100% owner of both properties, both companies. And then the other question that I had would go to Joe, and that was when we are developing our business and we're getting involved with these exports, and as we're looking at our company as a whole, we've also been able to apply for and get these EIDL loans. And I was just wondering, we've built a new facility to handle some of this exporting and some of the manufacturing parts. Is there any opportunities, and who would I talk to maybe bundle a bunch of, either can you combine an EIDL loan with an existing asset loan to put together a bigger picture strategy? And is that something that the SBA would be able to assist with?
Yeah, I think so. So the EIDL, the economic injury disaster loans, those have, I believe, they're a 30-year term, right? So that's a separate term loan. And if you're looking for some additional financing, SBA is certainly willing to work with you on that. Now, the EIDL loan typically has it has collateral, right? There's probably a lien on your business assets for that. Now, if your lender is interested in wants to do another loan for your expansion, then they can request, and they're going to require that they have a first position. So SBA is already in a first position. So you would have to get a subordination of that collateral on the EIDL loan in order to accommodate the new loan. And SBA is very, willing to subordinate, again, depending on the situation, depending on the type of financing, the size of financing, but typically the SBA will agree to subordinate their position to the new debt coming in.
Okay.
So, hey, Tom.
Yeah.
I think we may have lost Rich. I don't know where he went.
Oh, that's okay.
You know what? I can answer his question. I wasn't completely paying attention. You have an entity in the United States, an entity overseas. You're selling the product to and you own both entities?
Some of it is conceptual. We're just now starting this. So I'm in Sweden now. I have residency in Sweden, and then I'm an American citizen. We import European forestry equipment. So I am the #1 importer of Logasol portable sawmills, which is a Swedish brand, and we sell them throughout the United States. And now I'm looking at taking the American large heavy sawmills and I want to sell them in the EU. And I want to use the network that I have in the EU to export this product.
Okay.
And I can appreciate what you had to say about the 300,000, because I'm doing this with my vendor in Sweden, trying to show them that the US market is big enough for them to trust me with their product.
So you're wanting to take your US made large product and get it over into overseas markets. You have a location, a wholly owned subsidiary in an overseas market.
Yep.
So you're trying to get the product over there and then on-sell it into the market to an end user?
Yes. Yes,
So there's
exactly.
a concept with ExIm Bank where it's an export transaction, but ExIm Bank won't support transactions to yourself. But what you're really wanting to do is we would put in place an ExIm Bank program for your US entity. You can go ahead and ship the product over to your wholly owned subsidiary in the overseas market. We can wrap ExIm Bank support around your US entity and what's called an additional named insured. Because ExIm Bank sees this a lot. They see, okay, you've got an office like down in Mexico, and it's best to send our product down to our office in Mexico and then sell it into the market. So we put an ExIm Bank program in place for your US entity. We do an additional named insured, which is going to cover your overseas entity sales from that entity into Europe. So you would have receivables then generated by your overseas entity to a European buyer, and you want those receivables protected. And yes, ExIm Bank in theory will do that.
Yeah, that's exactly right. And then I'm trying to figure out how we can leverage our US office. So if we can generate European leads and work with people in English on our phones in the United States, this is really just, I'm in an office. I rent an office in Sweden. And the shipping is really going to be a transaction that happens after the sale. We have to find the buyer first and then work in reverse. I mean, these are $68,000 to $80,000 machines that are custom built for the customer, you know. Congratulations to you. This is great. I mean, this sounds like exciting business. ExIm Bank can support a lot of what you're saying. Okay. We should sit down and break it all down and write it all out. I would love that. Yeah. And it sounds to me like a real clear business plan is a good way to start with everybody here, you know, so that we can, you can see where we're trying to do. Yep.
And I see Brent, Brent, you put a question into the chat. It's a great question. If SBA provides support to the bank, then if SBA provides support, meaning the guarantee of SBA, then there's a non-payment situation by an overseas buyer. SBA will protect the bank, but is there still SBA recourse to the bank's client? Yes, so the bank is protected by the SBA guarantee. The customer or exporter is not, and that's where the export credit insurance comes into place. That's for the protection of the exporter. Yes, the bank is somewhat protected too, because if their customer is protected, they're protected. So without that export credit insurance in place and that overseas customer doesn't pay, the exporter is on the hook to the bank to repay that line of credit, whether they're paid or not. So that's why it is critically important to think about and utilize these tools like export credit insurance, because there's so many situations where they're valuable. I know Rich mentioned it in a slide, but you know, maybe you're selling to a country where there's significant depreciation of their currency, and it's not a situation where the company doesn't want to pay, that they're a bad business and they just don't want to pay the bill. It's that they can't pay because that US dollar invoice that you just sent, now it costs them twice the amount of their local currency to repay that. And that's a can't pay. And a can't pay is something that can be covered under your export credit insurance policy. So critically important for exporters.
Yeah, I was having trouble like figuring out in my mind. I didn't know that this stuff was available. So I mean, the terms on our buyers, basically when I would be on the phone with an international customer, I'd say, you know, maybe we'll do 25% of the value of this product and get it started. But then I need 100% of that payment 10 days before it leaves the manufacturer. And otherwise, we're not even going to think about shipping it to you. Otherwise, we're vulnerable. So I'm trying to like figure out what else do I have in my wheelhouse, and that's good to know, all of these.
You know, Tom, that's prudent and that's responsible for you to think that way. Totally agree with it. On the other hand, if you had a really great partner like ExIm Bank, and if they agreed to protect you, to extend the terms that that buyer wants, would you do more transactions if you're able to meet the needs of
Absolutely.
the buyer with ExIm Bank as your partner? Then that would be.
Do you guys do any, are you strictly export, or do you also do this with imports? Because what we found was we were cruising with these Swedish sawmills, couldn't get them fast enough. We were the 300,000, you know, they extended our commercial credit. We were selling them faster than they could ship them. And then, you know, it was like an accordion. Once a year, we had to bring that balance to zero.
So the answer to that question is really interesting. The Export-Import Bank of the United States is what they refer to as an ECA, an export credit agency.
Okay.
Turns out that most countries, especially all developed countries, have their own ECA. So when you're here, you want to sell it to a buyer overseas and you want to extend them terms. Well, in fact, those European sellers of product want to sell it to you and extend you terms. There's an ECA, an export credit agency in those overseas markets that can help them do that the way ExIm Bank helps you typically.
Cool.
Usually.
Cool. I look forward to following up with you on this too. And I thank you guys for the advice and the willingness to help us.
Yeah.
Everybody.
Yes, thank you. I'll recap it. Thank you to everyone for putting this on, because we are a little past the time. So we want to be respectful of other people to close this out. And again, thank you for the panel here to have come on, and the SBA and everyone else for putting this on. If you have registered, you'll get access to the slides and the YouTube a little later on, probably today, maybe at the end of the week. And otherwise, if you're watching this, it's a YouTube. We're going to put the series on YouTube so you can catch everything if you have missed that. So thank you again, and please enjoy your day.